what is going on. Let's find out what the story looks like with Caroline Hyde at the touchscreen.
Guy, new week, same old problems, same old risk aversion. We're likely to see a drop in European stocks today. Last week, we saw the Stoxx 600 give up 640 billion euros worth of its market capitalisation. It was down 6.7%. We're seeing FTSE just clinging on to gains this morning, but there it is, turns into the red. But as we warm up into equity trading, it's once again China front and centre. A 46th month of dropping producer prices. Of course, that's a key concern. Meanwhile, Joseph Stiglitz saying, look, this is not cataclysmic, if I can even say it properly, cataclysmic. It's not that much of a worry, but clearly the market thinks it is. Down we go in terms of getting out of the riskier assets. Down go stocks. We're currently trading in the red. FTSE 100 off by 0.25%. Remember, we've got European investor confidence later today. How will that pair out? We're expecting it to remove. It's not going to be nearly as strong as we've seen in previous months. We're seeing the euro deteriorate ahead of that number. We also have two Federal Reserve spokespeople coming out. Remember that phenomenal number in terms of US jobs on Friday? But a vague memory now as we look at the risk aversion once again, and people worrying actually more about in the US the reality that wages aren't increasing at the same time as jobs are. Euro off by 0.2%, but once again it's risk aversion when it comes to commodities. Oil down by almost 3%, Brent trading 32.58 at the moment. You're seeing copper sell off, that's currently off by 2% as well. Once again, China and the slowdown in the world's second biggest economy in the forefront of investors' minds. Meanwhile, money moving into the havens, getting into gold, getting into yen this morning. You're going to be speaking about that much more with our Asia reporters. Let's have a little look though perhaps at the odd stock that you should be watching this morning and what's come out in terms of a few changes of management, but also the effect of market moves. The Rand, you were just saying, hitting 17 for the first time ever, record low after record low. It affects Old Mutual. It's the biggest insurer in Africa. It's founded in South Africa. Exposure drags down Old Mutual. Look out for Investec as well. Meanwhile, Electrolux just clinging into the red, up 0.4%. A new CEO, Keith McLaughlin, waves farewell after 5 years at the helm. He will retire on the 1st of February. That's after that GM deal, of course, got kiboshed last month. Meanwhile, Taylor Wimpey just actually down by 0.1%. Many calls for it actually to do rather better than that after its results were strong. We saw Taylor Wimpey record operating profit margin, home completions higher, average selling price up 8%. You know our obsession with the house property here in the United Kingdom, Guy. Back to you.
Caroline, thank you very much indeed. The Spanish data we just had, industrial output coming through at 5.7, very strong. Just point that one out, certainly versus what we were looking for versus the prior month. So the markets are open, broadly flat, I would argue, here in Europe. Let me tell you what's coming up in the rest of the show. First up, the sell-off continues. China stocks extending their slide amid growth concerns. We're going to talk China, then the Rand record. The South African currency weakens 9%, where it did so at 1 point against the dollar. We got through 17. We're going to go live to Joe Berg with the latest. And later in the programme, Saudi Aramco's global refining empire may soon be on offer. We're going to get the latest as the company mulls selling shares in its refining assets. So, Chinese stock market doing exactly what it did this time last week, and we have seen an extension to the falls that we saw throughout the week. Factory gate prices overnight, over the weekend, fueling concern that the economic slowdown is deepening. Nobel Prize-winning economist Joseph Stiglitz told Bloomberg, though, that China needs to boost demand to avoid a deeper downturn.
I'm of the view, obviously, you have to have both. You have to have but if they push too much on just the supply measures and not enough on the demand measures, then you could see a deeper downturn.
Joseph Stiglitz. Let's talk to Robin Ganguly now, Bloomberg's Asia and Emerging Markets currency editor. Robin, let's talk about the currency first of all. China keeping the reference rate little changed over a second day. How are they managing it? Is it possible to kind of read day to day what's going on here in terms of the thinking of the authorities?
The question, Guy, now is China losing the plot? Is the Communist Party losing control of its of the markets? Is it not being able to control the markets as it would want to? So what's going on now is that we've seen that today, for the second day, like you said, they stabilized the fixing. They had the state-backed firms buying shares in the equity markets last week, and everything hasn't worked. So today we have stocks dropping 5%. That was kind of unheard of over the past year and a half or so. China was seen as a rock in Asia, in emerging markets, where if you went in, you wouldn't really lose too much money. But things are looking quite somber at the moment, if I can say that.
Robin, I've heard a lot of people talk about the fact that the Chinese stock market is not the Chinese economy, and you shouldn't equate the two. But the volatility we're seeing at the moment is being reflected in real numbers that do affect the economy. For instance, we're seeing the cost of interbank borrowing in the yuan in Hong Kong jumping sharply, jumping by the most on record. That has got to be something of a concern.
Well, definitely it is, and it's the concerns are that this is going to get worse as the PBOC continues stepping into the offshore yuan market, buying its currency and starving the market of liquidity, so to speak. This goes on to affect not just the currency; it affects bonds as well. It affects money market rates as well. It has a far wider impact, and this is something that will affect stock markets, bond markets, everything across the board, and there's no saying when this will when they will let up.
Robin, nice to get your thoughts. Thank you very much indeed. Robin Ganguly, Bloomberg's Asia Emerging Markets Currency Editor. Let's go to South Africa now, where the Chinese turbulence and to a certain extent the domestic factors are taking their toll on the rand. The currency has plummeted by the most in 7 years. We've hit a rate against the dollar that we haven't seen since October 2008. I'm not even sure we've been at 17. Joining us now from Johannesburg is Amo Mbata from Bloomberg News. Amo, how shocked are currency desks down in Joburg and elsewhere about what we've seen overnight?
Hi, Guy. I mean, very, very shocked. We saw the rand fall through the 17 rand to the dollar mark and almost reaching that 18 rand to the dollar mark. And that was during Asian trading. I mean, the sharp drop of 9% due mainly to traders pulling away from the rand. And when we saw the rand going through that 14 rand to the dollar mark just a few months ago, that was also during Asian trading. So just showing you there that liquidity is very thin, Guy.
Are we going to see the authorities stepping in? Are we going to see intervention from the central bank? Are we going to see possibly rate hikes coming through? Because this is going to have a huge impact on inflation. At the same time, though, we've got an economy that is on its knees.
Definitely, we've got an economy that is struggling in South Africa, and we saw the rand lose 25% of its value just in 2015, and that also coming from the lackluster growth that we saw, a slump in commodity prices, as well as the sell of an emerging market currencies coming off the US Fed kicking off its rate hiking cycle. I mean, Bank of America, Merrill Lynch this morning saying that they are expecting that the South African Reserve Bank may have pressure to increase rates by 50 basis points later on this month when it meets in